welcome to Friday, another Talk Money with Tom show. Today we have this live show every Friday. We're trying to help people improve the financial aspect of their retirement. We think it's really important. There's not a lot of resources out there. We do that mainly through answering your questions. So you can ask those questions now if you'd like. You can do it two ways. You can send in an email to the address here on the screen, asktom@talkmoneywithtom.com, or you can put them into the chat box, and we'll be able to try to answer those live. Of course, you can send in the questions at any time during the week, and then we often cover questions that come up with our strategy sessions with our clients. So hopefully we'll find something today that helps you kind of move towards your retirement goals. And whether you're retired already or looking forward to it, a lot of the subjects that we cover in the area of asset management, retirement planning, and tax planning, it really can help you, irregardless of what age, as you head towards or accomplish your retirement. We believe that the more you know and the higher education level is in these particular subjects, the better you're going to do, even if you have an advisor. And so we created this channel. We have over 1,000 videos on the channel now. You can subscribe to the channel if you'd like, and then hit the little bell button to get notified when we put new content. And the object would be just to try to continue to build your educational level about these subjects. And the last thing, of course, if you're interested in meeting with us because you want to just ask some specific questions that are personal to you, you can do that. You can go to our website, hit the book appointment button up in the corner, and be able to set up a 30-minute phone or video time with Ethan and I, and we can try to help you as far as that goes. So really looking forward to today. Hopefully we can find something that really gets you going in the right direction as far as that goes. Do like to start off each one of the sessions that we do here live on Friday with a summary of what we saw happening in the market this week. And so Ethan and I are going to kind of have a conversation about what we saw here. And this is the S&P 500 from the peak, the beginning of last year. Mm-hmm. And you can see that red line, is that trend line across the top. We hit it back in March. We hit it again December 13th. It's sort of like a live wire, unfortunately. We seem to get to it and then come back down. And that blue line is the 200-day moving average. We actually had 3 times here, in the recent past, the end of last year, beginning of this year, where we actually got above the 200-day moving average. That's significant, but we haven't held it, including this time, as far as that goes. So we'll see what happens, but we're not far from the 200-day moving average. Mm-hmm. We're not far from the red trend line either. And one thing that is different, if you look at the previous times where we got close to the trend line, it came pretty much straight down, right? I mean, all the way down. This time we started straight down, but then bottomed out, and we've come back up fairly quickly. So that's a good sign. One of the things I'm seeing is there's a lot of strength in the market as a whole. We're seeing that, in some of the more risky areas are starting to move. And so that's a sign that things could be changing, and we'll see how that plays out. We do have earnings season coming, right? And we're in the middle of it, and the big companies are coming out. And one of the big things that's being talked about right now is that earnings expectations are too high. And so the market, when it realizes that, as these earnings reports are reported, and future, future guidance comes along and says, hey, we think we're going to do worse, right? All of a sudden, you're going to get this, sell-off that's going to happen as the market readjusts for these new earnings projections going forward. And so that's really what we're kind of facing as a whole. That's the pressure against the market this first quarter and maybe even the second quarter of earnings reports that are going to come out this year. We're trying to see what the impact is of this higher cost, higher interest rate environment. How much does that impact earnings? And so right now, the analysts have projected that earnings would drop about 3.9% year over year. So fourth quarter of last year versus the fourth quarter of the year before, we should see a 3.9% drop. That's the first projected drop since the bad time in the pandemic, the first part of that 2020 downturn. So this is what we're going to be watching. But we had some very interesting things happen this week that I think are worth talking about. But for starters, I'll just show a chart. This is a 5-minute chart of the S&P 500 for this week, right? And you can see we started off the week kind of hanging in there, and all of a sudden we've had this big downturn section. And then actually the last part of that is all today. Really good run up today. So today is fairly easy to talk about, and I think one of the things that's the catalyst there is certainly the after-hours report from Netflix, right? I mean, the interesting thing about that, and last I checked, they were up in the 6 to 8% range, today. And the interesting thing about that report is they actually missed on their earnings, earnings per share. But they did really well in kind of the future guidance area, especially when you looked at the number of subscribers. So they were supposed to have 4.7 million new subscribers. They ended up with 7.7 million new subscribers, which is a really big jump. And this new version of where you can sign up for less cost with the ads has been going well. And so, here's the thing that the expectations for earnings coming into this quarter are lowered, and the pessimism is high. And these companies are great. I mean, they figure things out. I mean, Netflix certainly struggled, had some big drops last year, right? And now it's starting to come around. So these are the things that I'm hoping for. I think one of the rules of thumb that I always try to follow is that when everybody's saying it's going to do one thing and go one direction, so often it actually goes the other direction, or even if it does go that direction, it's already factored in because everybody's talking about it.
Yeah, the contrarian take.
Yeah, and so everybody thinks earnings are going to go down more than expected, right? And if they do, it might already be priced in. And if they happen to not do that, you could see quite a big movement upward, right?
Yeah, you can see that big jump for Netflix. You know, they were unexpectedly good.
Yeah, exactly. Now, we are heading into the next 2 weeks with the big companies, specifically the big tech companies that actually drive an index like this. So an Apple and a Microsoft and a, Google and such, which are such big companies on a capitalization basis, have more of an impact on this. And I think they could show some softness. Maybe it's already factored in. I mean, if you follow Apple's share price, it's not at a high point, that's for sure. Because there's problems in the supply chain for Apple, or, the softening of the economy. We're hearing about layoffs. You were telling me something about the Microsoft layoff that I thought was interesting. So they had 10,000 layoff announced this week, but... Yeah,
since the pandemic, they added about 40,000 jobs. So if you factor in that 10,000 job decline, it's still net 30,000 they've added.
Yeah, and tech companies like that are kind of famous for trying to gather people when labor gets tight and hold on to them for a while. And now they're seeing some softness, in the overall scenario. So we're seeing some layoffs there and such too. And but here's the big thing I want to talk about here is that big downturn. All right, so that downturn, if you watch this on a kind of minute-by-minute basis like I do, when the Federal Reserve governors came out this week, and there was 3 or 4 interviews altogether, the market went down because they were all very aggressive and essentially saying that rates were going to go higher, in some cases higher than expected, and stay there longer and longer than expected. And the market responded, and we ended up with this downturn. We'll probably still end up with a down week, even though we had the first 2 weeks were up, which was nice. So it works. They come out, and the object for what they're trying to do there is that if the stock market takes off, it eases financial conditions, which makes people spend more money, which of course creates more inflation, which is exactly what they're trying to fight. So they're trying to use their words in order to bring down the market and keep it, under control. Now, the thing is, it's sort of like crying wolf. They keep talking about it, and here we go. We're coming back already. These downturns that we were seeing that would last for months after these conversations are now really lasting for days, and the market's coming back around. And I guarantee you by next week when earnings are hitting, that's what we'll be talking about. We'll be, and not what happened, not what the Fed said. But I do want to address what the Fed said. So if they're going to be higher for longer, you have to keep in mind that the Federal Reserve has been fairly inaccurate, let's say, so far. So go back to 2021, inflation is transitionary, right? Not so much, it's still here. And in September of 2021, they actually said that they would not be raising rates at all in 2022. Well, Not so much. We ended up with, one of the biggest rate increases in history, especially on a percentage basis, happening in 2022. So what they're saying now is that rates are going to go higher in some cases than expected and stay up for the whole year, and they don't expect any decreases in 2023.
Yeah, and the market's only predicting probably 2 quarter point increases for the next couple
That's
months.
exactly right. And so there's some different ways of looking at that. And I've got some charts here. So number one, here's the 2-year Treasury yield, which is very sensitive to federal fund increase rates. It's the one to fall, in my opinion. And you can see it peaked out and it's been coming down. And even after these aggressive comments, it actually went down this week. The yield went down. And so the bond market is saying that things are going to get softer in the future and inflation isn't going to be as much of a problem. It's going to continue to improve, at least on a projection basis. That's what the bond market. So you got the bond market making a projection and you got the Federal Reserve making a projection. But if you go back and look at the 2-year Treasury back in September when they said they weren't going to be raising rates, it was already starting to go up. Mm-hmm. And so the bond market's been more accurate than the Federal Reserve. And so the bond market is saying, no, you're not going to be raising rates as more than expected, and you might not be keeping them up all year long. And another view of that is the Fed funds futures market. And so what this does is kind of make a guesstimate for where the Fed funds rate will be, in this case, in July of this year. And you can see the little down arrow. It's kind of flat, really, but yeah. It was at 5.1%. It's now at 4.9. So to get back to your quarter point increases, the market right now expects a quarter point increase in February and another one in March, and then things would stop, and because this is going all the way out to July.
Yep.
And so 4.9 is about 0.5% higher than where we are right now, and so it's all built into one projection there. So I would probably spend more time looking at what the markets are projecting and actually looking at what the Fed does more than what they say they're going to do. Because they might be saying what they're saying just to try to bring the market down, and they won't actually end up executing that. There is a fear, rightfully so, that the Fed will overraise rates, that they will actually do what they're talking about, and that's what scares the market the most.
Yeah, the market's seen a lot of, there's been mixed data coming out in economic reports, but people are getting a feel that there's softening of the economy.
Yeah, on the big day where things dropped, if we go back to this chart, that biggest drop right there, we had a report coming out saying consumer sales was slowing down. At the same time, we had an interview in the Wall Street Journal by the St. Louis Fed president saying he's going to raise rates to 5.5%, or thinks 5.5 is a number we might get to. And again, remember the market's thinking 4.9. And so that scares the market, because if they're not looking at the data and not paying attention to the data, they could overraise rates. And the data is showing some softening. And you can see that in the Microsoft layoff, even though they've had a net, increase. Still, they're talking about seeing some things in cloud computing in different areas. So, the last part I'll show you here is the Fed funds rate market for July of 2024, a year from the last chart. And that's down quite a bit. As a matter of fact, it's hard to see this, but the projection is that the Fed fund rate will fall to 3.4%.
Yeah, and that's essentially saying that people are predicting a recession of some sort, and Fed has to reduce their rates.
That's right. And so here's the Fed saying we're not going to reduce rates in 2023. Here's the futures market saying, hey, by 2024, you're going to be quite a bit lower. And so there is an expectation that we might see some dropping of the interest rates in the second half of this year, especially because that's when we're starting to see the most likely outcome of recession starting at that point in time. And so again, what does the Federal Reserve say they're going to do? What do they actually do? These will be really important components. And then, of course, this recession that it looks likely, right? With you look at most of the different, including this is a decent indicator for what might be happening, because they're not going to be lowering rates unless there is inflation is down quite a bit and there is enough reason on a recessionary basis to do so, right? Yeah. So that's exactly what this is saying. But how steep is that recession, and how much does that impact earnings is the ultimate question. And that's the part that I think we'll be focusing more and more on. It's why this quarter's earnings are so important, next quarter's earnings are so important, because we're going to be able to find out how much of an impact all of this has had on earnings. But under the surface here, we've got a scenario where households are still fairly sound. They're borrowing more, and credit card debt's going up and what have you, but still fairly sound. Look at businesses. They were able to refinance at these low rates all of their debts and what have you. Businesses as a whole are still fairly sound. And maybe most importantly, banks are sound. And mainly because of the 2008 disaster. Banks have been forced to, do different things. And so they're in a better position than they have been. So that big 2008 downturn happened because of the financial crisis. We don't have that type of mixture here. We have China, right? And so they've reopened. How does that impact things? And so, what goes on here is really just trying to determine what the severity of that recession is going to be, right? And that's what we're going to be watching. The fact that consumer sales dropped says, okay, that is a recessionary issue. But in an inflationary environment, consumer sales have to drop. The fact that there's layoffs at Microsoft and now Google today with 12,000 people, well, that's normally a recessionary kind of indicator. But at the same time, labor costs and the tight labor market is creating inflation right now. So again, we actually have to have this slowdown in order to have inflation kind of come down. It's just a matter of how much. The perfect zone, kind of that Goldilocks zone where the markets kind of can do quite well in this environment, because there is a lot of pent-up demand to spend. China is going to get through this COVID aspect and unleash that massive population, the second largest economy in the world, to go out and travel and spend money and what have you. So that offsets recession, but also brings back in the possibility of inflationary pressure. So we've got two things we're dealing with here that are kind of polar opposites, and it's a really, really interesting environment to be studying. So anyway, that's what we see happening right now. I think things are still pretty good. We'll know more over the next few weeks as these earnings reports come out. Again, there's so much pessimism about those reports. I wouldn't be surprised to see the market hold up, even if some of that comes to be true. The debt ceiling issue, there's so much going on in the debt ceiling right now, the conversations. But again, if you look back over time, the debt ceiling impact has been less and less. So again, it's sort of like the boy crying wolf, it's, go back to 2011 when we had a really big one, the market dropped 17%. If you look at 2021, the first argument over debt ceiling, the market dropped 10%, but the second one, it dropped 5%. So, again, people are looking at this as potential buying opportunity if there isn't a default, which would be catastrophic. But if there isn't, there's maybe less and less impact to the markets that happen there too. So generally speaking, again, things that people are talking about a lot are already kind of factored into the market. And so it's more the things that we're not talking about that we need to be concerned with. And one thing we don't know is earnings, because they're protected and they're kind of hidden, and we don't find out until they announce it. I don't think anybody expected Netflix to have that many new subscribers, for example, right? So good stuff altogether. All right, so let's get into our first question. What do we have today?
Would gold be a good investment play for the debt ceiling fight?
Yeah, that came in actually as a comment on one of our videos. I put out a video every day talking about what I saw happening in the market, and somebody asked that because we brought that up in kind of a debt ceiling issue. So I do have some charts for that too, so let me show you these and we can kind of talk about this. So this is the 2017 downturn. The green line is VTI, which is the Vanguard Total Stock Market Index ETF, and I use that as an index for the whole market. It's got over 4,000 stocks in it, and what have you. If you look at that first red arrow there, on the green line, I just picked that as sort of a peak point as the arguments really started, and I put a corresponding arrow on that gold line that represents GLD, which is the gold ETF, right? Now, the bottom of that, where the green arrow is pointing to the green line, that was when they finally funded, extended the debt ceiling. That was a 17% drop there from that, kind of high to low, roughly. But this was a really big time scenario where they went up to the last almost hour. I think it was August 10th of 2011. The federal government had already gone past the debt ceiling, or had hit the debt ceiling, was using what they call extraordinary measures.
Yep.
Cash that they got laying around or whatever, but they were out of that, and those extraordinary measures were ending, and they had nearly a $900 million payment that they had to make into Social Security, so everybody would get their Social Security check. And then the Republicans blinked in that environment. Actually, it both did, to be honest, because there was some negotiated settlement there too. But nonetheless, they funded the government. But gold went up. See that? If you look at the red to the green arrow on the gold went up during that time frame. So it would have been a good bet to have that going into that. However, if we look at the last debt ceiling arguments, there's two of them here in 2011. And so here we have, the first green, again, is the stock market, and gold is the gold market, more or less. And market went down for the first one, 10%, gold went down. Yep. And then we had another argument in November of that 2021, because they didn't extend the first one very long, just a few months. And again, the gold went down at the same time. So you kind of wonder overall if the debt ceiling worry is starting to wear off. Again, it's the boy crying wolf over and over again, because what we're seeing is less and less drop in the S&P 500. And I think maybe that's sort of reflected in that less and less drop in increase in gold, because people are looking at that as, okay, this is a political theater. It is dangerous theater. They could default. It isn't something we should ignore. Yep. But so far, that's what it's been, right? And so the market's been kind of responding. So, however, so you would look at this and say, no, gold isn't going to do what it needs to do to protect me if there is a debt ceiling, argument that brings down the market. But just in general, this is the current gold versus the total stock market index. And actually, gold's been on a run.
Yep.
So just, from the standpoint of momentum, you might make an argument that gold could be a decent investment here, irregardless of how it reacts to the debt ceiling. The question was about the debt ceiling. I personally don't know that I'd run out and buy gold for the debt ceiling. I think that what we're seeing on a pattern looking back throughout the debt ceiling arguments is less and less impact to the stock market, and less, response from the gold market for that one specific issue. However, altogether, gold has had a pretty nice run here. It might be something to look at. I'd probably want to really check and see how much it was stretched, maybe come in at some lower points and those types of things. But that's another piece of the story. But anyway, that's what's going on with, buying gold question inside of this thought process of protecting ourselves from the debt ceiling. If you really want to protect yourself from the debt ceiling, you probably move some money out into T-bills or something along those lines to just wait and see what's going to happen. But it's a tough one.
T-bills might be dangerous if the government defaults, though.
Yeah, I don't know. It's kind of interesting because the threat that happened in 2011 wasn't so much the default on Treasury debt itself. It was actually a default on a payment into Social Security. And so there's a whole host of places where they might not put money if they couldn't before they get to the Treasury market. However, it would be a big deal. It would send a shockwave through the global markets. And of course, my outlook right now is, of course, we on the 19th we hit the debt ceiling. Yesterday, and so now we're working under extraordinary measures. And so I've seen projections that we can keep going anywhere from June to the end of August. Right? Depends on who you're reading and what they're talking about. And it's a guess anyway, because it depends on how much revenue is coming in, what the actual expenses are, and those types of things. But I wouldn't be surprised to see the argument run out all the way through that time frame. They need 6 Republicans in the House to join all of the Democrats in order to get a bill on the floor to be voted to increase the debt ceiling. I think there's 6 Republicans out there that would stave off a global disaster, but maybe they wait for a while.
Yeah, and the only issue with that discharge petition is it has to languish in committees for 30 days. So
Yep.
there is a timeline that
Yeah.
it's not a quick process.
Yeah, we're not solving this debt ceiling issue within 2 months, in my opinion. There's too much political capital to be gained here by pushing, we're trying to, yeah, it's a good fundraising opportunity for these emails that are being sent out. There's all kinds of things that happen here. And there's too much repercussion for stepping across the line and joining the Democrats. There are some Republicans that are in blue areas and purple areas that might be more motivated. But in the end, I think there's 6 Republicans will step across the line. I just think it'll take a while before it does happen. So, yeah, it's a good question.
Should I be looking into putting some extra money that I need in a couple years into a CD, or just keep it in the current high yield savings account I have?
Yeah, so a high yield savings account has a big advantage in that over a period of time, it continues to go up.
Mm-hmm.
And so if you feel like interest rates are going to go up and up and up, then you might want that flexibility of a high yield savings or a money market or whatever you want to look at right there, and starting to see that continue to grow. Because if you lock in on a CD and it grows a lot, right, then you should have kept it in the money market or high yield savings to get that increased gain. The opposite is true if the expectations that rates are going to go down. So I'll go back to some of the slides that we used in our summary here. So again, if you look at the 2-year Treasury yield, it is coming down right now. Mm-hmm. To me, that's a projection that interest rates are going to come down. If we look at the federal funds futures market for July, it's coming down a little bit. If we look at for July of next year, it's down quite a bit,
Yep.
right? So it goes from a 4.9% projection down to 3.4. So right now, if you look at the futures market, you look at the bond market, it is projecting that interest rates are going down. So that a high yield savings account might have already be peaking in terms of what it's going to pay, and then start to come down as rates come down. So this would be a better time to be locking into a CD of some type. I really like probably the 12-month CD right now, but I could be talked into a 24-month CD. But certainly 12 months from now, we could be at a situation where that 12-month CD is new ones are paying less, and you'll be very happy that you have that one now.
Yeah, the issue with CDs is you're locking up your money.
Yep.
You lose that flexibility.
Yep.
If you have the high yield, you can always take money in and out of it
Yeah.
without any issues.
Yeah, exactly. That's certainly a consideration in terms of if you need the money within a year, then you throw the CD idea out the window.
Yeah.
Because you basically have no flexibility there, and the high yield savings works. But assuming that it's sort of a longer term investment, then the CD is not a bad choice right now. And that's a new thought, just because
Mm-hmm.
we're starting to see the projections for future interest rates dropping. We've seen all kinds of things. I mean, mortgage rates are down, I think 6.17. They got up to right around 7%.
Yeah.
We're seeing those come back down. And again, we're starting to see that the other side of that. If you look at the forward-looking mechanisms, you can kind of get an idea for what you should be doing in terms of CDs and what have you too. So, yeah, good question. So
I might be on the chopping block for a round of layoffs. How should I prepare for this?
Yeah, that's an interesting question, right? I mean, so I'm thinking I might get laid off, right? What do I do?
Mm-hmm.
Obviously, the timeline that you have is short,
Yeah.
right? So it's kind of hard to do a lot. But one of the things that you might think about is making sure you identify all the resources that you possibly can in case you can't get a job for longer than expected. So one of those resources, if you have a home with some equity in it,
Yep.
could be a home equity credit line, right? And this is basically a checkbook that you're given to write out checks up to a certain dollar amount against your home. Not an ideal situation, but if you've already used up all of your thing and your family needs to pay these bills, it's not a bad last resort.
Yep.
And so if you have a what's called a HELOC already, then great, you're already set up. But if you don't, you might want to run out and get one,
Yeah.
Well, you still have income, right? Maybe you don't get laid off because that's how that question's being phrased, the possibility, so it hasn't happened already. And so prior to getting laid off, it would be nice to be able to show an income, right, to qualify for that HELOC. And sometimes the last one I got on my house, I got it in a week. So they can be accomplished fairly quickly sometimes. It depends on the institution. But nonetheless, so that's one concept, right?
Yeah, so usually most advisors ask that you have some sort of emergency fund,
Right.
with depending on how many months of income you want to have. Some people say 6, some say a year. It really depends on your situation, your comfort level. So how much, cash do you have on hand? What is your kind of current burn rate? Did you establish this emergency fund while you were spending less money and now it's kind of below what it should be, or is it, the right number? And so that those are things you kind of figure out. And then you should kind of like a startup, how much money do you spend per month? What's your burn rate?
Yeah.
And then you can kind of figure out, okay, I have 7 months of lead time to find a job. And then if you're laid off, you always have that option of unemployment. So you can also think about that as an additional resource.
Yeah, I think it's very important, to have that, emergency money established. But if you're facing layoff, in the next month or something or whatever it is, you're not going to be able to increase your savings rate very much in that short period. But exactly what you said, you really can focus right away on what you're spending money on and change that as much as possible. Lower that burn rate, that money that's going out. Maybe there's some money that comes in from unemployment, so that helps. What's the differential between what you're spending and what you're getting in from unemployment? How much can I reduce that? Because the more I can reduce that, the less I'm going to burn these other assets that I have, right? And I can make them last even longer, right? Because you never know how long it might take to get a job. Maybe it's really quick and it doesn't matter. But planning for some, time there. I think burn rate, get resources up, get a HELOC, those types of things are probably, quite valid as far as that goes. Assume you are laid off before you are, if you think you're going to be, and start spending as if you were laid off. Maybe cut back on some of the things that you can, at least until you find out more.
Yeah, and after that, there's some extraordinary measures you can always take. There's ways to access your retirement accounts. So if you're really if you have those, so if you're really struggling, there's ways to get extra money.
Yeah, exactly. And then, I've been through this with a lot of people over the years, and it can be a little bit devastating while it's happening because you're going backwards financially, right? I mean, you have possibly more money going out than coming in, and you're kind of liquidating things that you don't really want to liquidate and all those kind of areas. Having said that, I've been through this enough times with enough people, they get out of it. They get back to where they need to go, and they need, to get. I mean, my father-in-law was a, petroleum engineer during the big '80s downturn, and had 2 kids in college, and when he lost his job, and they weren't hiring in that business for a while because the price of oil dropped so much, and he ended up having to liquidate all kinds of things, including 401ks and what have you, in order to keep things rolling. And they cut back a lot, and they had some emergency money. But they ended up, because it took a while to find something, burning through that. But now, he's doing fine. Maybe not as well as he would have been doing without that. But they had a good savings rate. They just kept that going once he got a job again. They built everything back up. So, if you are facing that, it's a scary thing. But I've seen a lot of success stories in the end. So keep that in mind also.
So can you explain what a home equity line of credit is? And should I have one?
Yeah, home equity credit line, oftentimes if you have a mortgage at all, it would be considered the first mortgage. You can even have a second mortgage, which is sitting behind the first mortgage. And so the home equity credit line is just kind of in this lineage of money borrowed against your home. And of course, you have to have some equity in order for that to happen. And the banks are quite careful, so you're not going to get, the full equity out of your home, because if the home value drops, the bank could, lose out on that. But they're behind your first mortgage, so they have to consider that. So if you have a house worth, $1 million, and you have a first mortgage of 500,000, might be able to get an equity credit line for 100,000 or 200,000. They want to have a margin in case your house price drops in a bad market, and so, but the concept there is that you generally get a checkbook or ability to transfer money, electronically, and so so if I had a $100,000 equity credit line, I could take $100,000 out over time. And I'm going to pay interest on that. Usually they're interest only.
Yep.
And then that interest usually vacillates depending on where rates go. And so that's one of the dangers in an environment where there's a high inflationary situation, that your rate could go up. They normally do have a cap, but the cap can be quite high. It might be 12% or 18% or something crazy. And so you could all of a sudden find yourself with a really high payment, even just on the interest on that. So it's not an ideal scenario for borrowing, but it's a place to have for just in case, as far as that goes.
And the nice thing is, if you don't need the money, it's just you pay a small fee to have that access to the money. So you're not actually paying any interest payments until you actually take the money out.
Yeah, most of the home equity credit lines that I've seen, there's almost no cost, if anything at all, to set them up. So it's kind of free. The cost is your time and effort to answer all the questions, give them tax returns, all that stuff, which is a pain. But they're generally not an outflow of money. And then if you don't use it, maybe a small fee to keep it there. Sometimes that doesn't even exist. So you can kind of check, what's out there as far as that goes. But it's a good question. It's something that comes up. We generally recommend that somebody try to get their HELOC established prior to retirement. So here I am. I'm gonna retire next year. I don't expect to need the money. Maybe I've even paid my house off, but I might want to have a HELOC, a $250,000 HELOC, or whatever it is, in place while I'm still working, because I qualify easier. We've had a lot of clients in retirement that have a little bit harder time qualifying for things because they no longer have that income, even though they have a lot of assets. Those mortgage people love to see incomes. And so while you're still working, that's not a bad idea to establish one of those to have for your retirement. And maybe you never use it, but what if there's a massive family emergency that goes beyond your resources, or a health situation or whatever it might be? It's good to have that just in case.
It's like a good secondary emergency fund.
Yeah. I'd say the danger is if you have it, it might think about spending it, and all of a sudden, that car looks interesting, that
or
kind
that
of
remodel
thing.
looks nice.
That remodel or whatever, and so that there is how you start to kind of accumulate your debt because it's available. So it's like having a high credit card balance, essentially. So, but so you still have to keep your discipline even in that environment for that to work, as far as that goes. So, yeah, good question.
What's the difference between a government shutdown and a government default?
Probably about 50% on the stock market, because the government shutdowns have happened quite a few times, and this is where they've got a budget that isn't being approved, and like we just had a budget pass just before Congress switched over, and it allows, the different departments to have their money to pay payroll and all that type of stuff. And so during a government shutdown, they'll usually, a bunch of people aren't getting paid. And the ones that are considered critical to the infrastructure. That's probably pretty debatable. But nonetheless, we've seen a number of these, some of which have lasted quite a while. Stock market just continues to move along in that environment without any real problem. A government default, on the other hand, is what we're dealing with this debt ceiling concept, where we have this really bizarre thought process in our laws where you have to approve, Congress has to approve to increase the amount that the government can borrow in order to pay these bills. And even though Congress has already approved the spending of that money with all these bills and budgets and what have you, the Congress still has to become a political football. And so theoretically, there will be a point in time, and we've been through this a few times now, right? So we hit yesterday the debt limit that was allowed, 31.7 trillion or whatever it was. We hit that. And so now we can't spend more, we can't borrow more. So we're using extraordinary measures. And that just means that they're kind of, using other cash. They're looking at these different big, retirement pieces that are sitting out there in the federal retirement plans. And they can probably fund the government from June to August, right? So ultimately, they'll get to a spot where those extraordinary measures aren't good enough, which is what happened in 2011. And we ended up with a, near default. And that was where they couldn't pay, the $900 billion money that needed to go into Social Security to make that, to make the payments. And so again, at the last minute, it was approved and it was pushed through. But this was after the market had dropped 17%, and we got knocked down on our ratings on our bonds during that period too, because U.S. Treasury bonds are AAA rated, but they got down to like a AA during that period of time because of that.
Yeah, one way to think about it is with a default, we're going to stop paying our debts. So like Treasury bonds, which is an investment vehicle that a lot of people use.
Yep.
And so that's where the issue really lies, is that it starts to spread into the investment world. A government shutdown, though people aren't getting paid, it's not the investments that are not getting covered.
Yeah, and we've seen defaults not in the U.S., but in 1998, Russia defaulted on their debt and basically just wiped it out. Now, it created a big downturn, about a 20% downturn. Came back very quickly once everybody realized Russia's economy is roughly the size of Florida, so it wasn't a huge issue. But we've seen situations like that where there's been renegotiated situations like Argentina and Venezuela, and so but it hasn't happened here. But it's a big difference. It's a really big difference to understand a government shutdown is really important to those people that are getting interrupted by this. It's important to the functioning of the government, not as important in the investment world. Hasn't really had a big impact. A government default is a totally different deal. That is going to have a financial impact. So yeah, it's something to understand the difference between, and that's you're going to be hearing a lot about this,
For the
this
next
year.
few months, yeah.
Exactly. As far as that goes. So, all right. Well, that's our show today. I really appreciate everybody coming today. I'm glad that you were able to come. I hope that we covered some questions. Thank you for sending those questions in. Keep them coming. You can post them on the comments on our videos. You can send them into the Ask Tom with Talk Money with Tom email address during the week. Give us a chance. I like making charts and such so we can find some visuals to show you to try to help you understand that. So send in your questions. Keep it going. We really appreciate it. It's fun for us to be able to answer all these questions. And then secondly, of course, you can subscribe to our channel. Continue to work on your education on these areas. Hopefully, as you listen to us, you can see there's a lot to learn, a lot of different subject areas. And so you can hit the subscribe button, hit the little bell to get notified. And of course, if you want to schedule an appointment to meet with Ethan and I, you can go to the book appointment button and push that on our website and set up a 30-minute video or phone call, and we'll answer your questions directly that way. So look forward to seeing you again next week, and should be a big week actually with all the different earnings reports that are coming out. It'll be very interesting to talk about what's been going on. So look forward to talking to you then. Thank you very much.